Neeraj ji, and we need to, evaluate your understanding of the subject. Whatever classes we have had, we have, taken you through finance, financial planning, financial statements, working capital, and there is one small unit on banking which is left. And the time that we have from now on, basically we have 3 weeks ahead of us. Now we have the next week, 13th, 14th. Then we have 21st, 22nd, I think. And then 13th, 20th, 27th.
26th and 27th.
26th and 27th. So we have these 3 weeks left. Now, in the last 2 weeks, that we will have to we have to keep that free for interviews, presentations made by you people. So I will give all of you the assignments, and those assignments you need to do, send assignments to me, and then we will have a, like I can ask you questions about your understanding, how you have made the assignment, and all those things. And that will basically be how we will assess your understanding of the course. What I'm also planning to do is that today and tomorrow, maybe we will devote to this financial statements ratios. Next time, we will try to do the banking part. On the banking, there's one small unit in banking. So we'll try to finish that up. And then in that, when we reach the, on Monday, I think what I plan to do is, next Monday, is to revise the course, the entire course. We revise the course quickly so that you're prepared for the assignments that come. And then the last week, of course, the 26, 27, that we devote to actually the actual assignment. So that is how we are planning to do this. Now, last week, Shruti, what you missed was, I don't know whether you got a chance to see the, Alice has also come now, very good. So I will quickly go through these, this particular slide here. So, Alice, are you with us?
Yes, sir.
So, Alice, I was just explaining to Shruti that we will be having, an evaluation of your understanding of this subject, whatever we've done over the last 3 months. And that will take place on the 26th and 27th of this month. Now, what we will do is, we will try to finish this last unit. This unit actually, practically speaking, I've covered most of what I wanted to cover last time. But since this is very important, I am going to do this again today. Then tomorrow, I think I can start with banking. And then we can maybe finish the banking part tomorrow, or latest by next Saturday. And then we will try to revise, whatever we have done in the last 3 months, so that all of you have a good idea about, we go through the course again. And then I will give you the assignments. You will have a week to work through your assignments, the last week, and you'll submit those assignments to me. And then we will have an online interview. You will present also the whatever you do, and that will be the evaluation. So there is going to be some work which you will do at home. Apart from that, in class, you will present what you have done and answer any questions which are asked. And lastly, there will be an interview covering the entire course. Simple questions on what we have done to test your understanding of the basic concepts. So I hope all of you are clear about this. I'm also saying this because since this is being recorded, you can always listen to this again just to be clear. So there is an assignment which you will do at home. Apart from that, you will present this assignment on the 26th. And then finally, you will also, after the presentation, I may ask you some questions. And then the last part, of course, will be that we will have an interview where I will ask you questions about the course which we have covered so far. So that is the way we will end the course here. See, the whole idea of doing the course was that you people get a reasonable clarity, basic financial concepts, also with financial planning, financial accounting, and a bit of banking, which we will do tomorrow. Now, coming back to this, this financial statements part.
Sir, I have one question.
Yes, Shruti.
Sir, in that interview, you will be only the one asking us questions and taking our presentations, right?
Yes, you're taking your answers.
Okay.
Basically, I'll ask you questions and I will take your answers. I will also allow you to do this one-on-one with me at any time. If it's possible, we can also do it like that. I don't have a problem. That is not something which has to be done in class as such, or we don't need to have a Zoom link for that. We can just have a video call and do it there also. That is also possible, the interview part. If you don't cover it in class, we can cover it that way also. You understand?
Yes, sir.
Alice, are you clear about this?
Yes, sir.
Yeah. So basically, today I just want to go through this part because this section is important from an assignment perspective also. So I want you people to sort of revise this section properly so that anything that is asked, you are able to do it comfortably. That's my main point. So I think I'll start with this now. Praveen ji had very actively participated in the class last time. Shruti and Praveen ji, I think both of you have, and I'm not sure, I think Tanya also had sent me the common size statements and the index-based statements. All those things have already been done. We have discussed all that. So, and then this entire section was also something which we did last time. Alice will recall all these things. And so let's start again. So if we are trying to analyze the financial statements of a company, one way of doing it is to look at it from, two aspects or two vantage points. One vantage point is the vantage point of profitability. The other is solvency. Now, the solvency part is also includes the efficiency, because since it's all related, this particular way of dividing the analysis of the financial statements, it basically just takes these two things, profitability, solvency, and within solvency, it also includes the what I've referred to here as the operating cycle activities, which are basically the efficiency aspects. So short-term solvency, operating cycle activities, which is basically efficiency, and the long-term solvency. So this is one. And the other, of course, is the more familiar profitability, which basically has four sections: margin on sales, margin on investment, return on investment, efficiency in the use of assets, efficiency is here also, and return per share of equity. So this is one way of dividing this. Now, we'll start with the first part. So if we look at the margin on sales, basically what we are trying to understand here is what, for every unit of sales that are made, what is the actual amount of profit that I earn. So the first thing which I look at is, if I just take the gross profit, that is, I find out the cost of goods sold, and then I take the sales figure, whatever revenue I've got, I reduce from that the cost of goods sold, I get my gross profit. Other income is also included here traditionally, but if I were to be looking at operating profit, then I would be eliminating the other income part. But anyway, if I just take all the revenue that I got, sales and other income, I reduce from that my cost of goods sold, I'll get my gross profit. And then I can find out what this gross profit is as a percentage of the sales that I make. So I know exactly how much money I'm making from my sales. First part. The second part is after I take the gross profit figure, and from that I reduce all the operating expenses that I have, I'll be left with my operating profit, which is basically the profit before depreciation, interest, and tax. So I'm just taking these because essentially what we are saying is, suppose all the money was mine. Suppose all the money which I'm investing in the business was being put up by the firm itself. There was no debt. In that case, how much profit would that company have made? Depreciation interest is therefore not considered because we just want to find out how profitable the business itself is. Number two, we don't consider depreciation because depreciation does not result in the money going out of the business. It is just an entry made in the books. And number three, we do not consider the we also reduce the tax because right now we are not looking at, we are just trying to find out how profitable the operations are. And since tax has no role here, we eliminate that also. So we get our profit before depreciation, interest, and tax. And then, of course, when from that we reduce the interest, the depreciation and amortization, the tax, we end up with the profit after tax. And we can always reduce each of these to a ratio. So when you are analyzing a statement, this is important for you. You will have to take the figures and derive these different ratios. So you will derive the gross profit margin, then you will derive the net profit margin, which will basically be the profit after tax as a percentage of the sales. So remember, this is what is available to the shareholders. This is very important. If the company is going to declare any dividend, it's going to depend on this, because this is the money ultimately which is left with the company. So this is one. And it is very useful when we want to compare different companies. So this is one. Then, before I go to this, so far, anything anyone wants to add? Shruti or Alice? Any questions up till now?
No, sir.
No, sir.
Okay. Fine. Then in that case, let me just a minute. Okay, the next is return on investment. Now, obviously, this is, as the word, their investment is there. What we really want to see is the promoters of this business, when they started the business, they had in mind that they will make some profit out of it. So basically, we want to find out what is the profit that they made on the investment that they made in the business. This is the basic thing. Now, we look at it from three different, or rather, it's all related, but we look at it from the point of view of the operating profit, the return on total assets, that is profit as a percentage of the total assets, and the profit as a percentage of the equity. Equity, of course, is the actual amount invested by the promoters. The total assets is more than equity. Why is it more than equity, Shruti? Quite often it will be more than equity. Why? Or Alice, why should total assets be more than, generally it is more than the return on equity? See, essentially, when we say total assets, we are taking the current assets, the fixed assets, and we are totaling them together. Now, the sources of funds for these, the current assets are often current liabilities, which is not equity, number one. Number two, it is also possible that the company may have taken some debt. So the equity, the debt, and the current liabilities, basically these three things will fund the total assets. So if I want to find out what is my return on the total assets, because that is important for me, because that return is something which is part of my profit after tax. Later on, that return will help me in increasing my profit. So the money which I put into the business, that gives me a certain amount of profit. The money which I borrow and also pump into the business, that also gives me a certain amount of profit. And it's sometimes referred to as a gearing percentage. So because of that, this return on total assets can sometimes be much more than the return on equity. This is one aspect. Now, the operating profit to operating assets, of course, is when I focus only on the profit made from the business, and I find that out as a percentage of the operating assets only. Now, if I take this one first, the operating profit to operating assets, what is the difference between the total assets and the operating assets? So essentially, it is actually all the assets that we have, but we reduce cash from this. So basically what we do is we reduce other assets. Maybe the company has made investments in maybe an allied concern, or it has bought, with the surplus that it had put in money in a mutual fund. Something like that has happened. So we, first of all, reduce those things. And we also do not consider cash. Now, the reason why we don't consider cash is, a very conservative view would say that since the cash is lying in a bank account, it has not contributed in any way to the creation of the total asset. So we take the cash out, and whatever cash was invested in the assets is obviously not in the bank account, it's already out. So we take the total assets. From that, we reduce the other assets like investments in other companies and things like that. And we also reduce the cash amount. Whatever we are left with are the operating assets. And the operating profit, of course, is the profit before interest, depreciation, and tax, but minus the other income. Okay, so is this part clear?
Yes, sir.
Okay, Alice?
Yes, sir.
Okay, fine. Then let's look at the return on total assets in that case. Now, the return on total assets is the ratio of the net profit to total assets. So this is the rate of profit the company earns after meeting the cost of financing a portion of the total assets. So if the company has taken some debt and that money which came in from the loan has been used to finance a portion of the total assets. So what you do is you consider the interest cost also over here. So you take the profit after tax, which considers the interest, you find that out as a ratio of total assets, and you are able to get whatever return you have. This is also known as the basic earning power ratio of the company. So this is the actual amount that the company is earning and making available to its shareholders. Actually, when we take the profit after tax and find out the percentage of that to the equity only, the amount which has been brought in by the shareholders plus the reserves which have been accumulated over the years, we get our return on equity. Now, here are two examples from Colgate-Palmolive India Limited. Both these figures are from that company's data. So profit after tax here, as you can see, in FY13 was 496 crores. This is in millions, so 496 crores. Total assets was 1,306 crores, and the return on total assets, this over this, is giving you 40.8%. Of course, this is a very, very high return on assets. This is a multinational company. It's a very strong brand. Most of us use its product. So it's to be expected that it will be this good. Then we also look at the return on equity. Now, I'm not being able to drag this. Now, if I look at the return on equity, see, once again, you have this fantastic return on equity of 107.4%. That means the company is actually earning as much as the amount that the promoters put in every year. So if you look at this, in the financial year 11, it was 113%. So look at this, profit after tax is 4,026 million, and the total equity itself is only 3,841 million. So this is a unnatural sort of performance, but this is the sort of performance which a good company with an excellent brand in the FMCG sector can actually get. You can see that the return on equity obviously is much higher because the amount is, the base is smaller. Here the base is total assets, 13067. In the case of Colgate-Palmolive, since I've read all the statements, the remaining assets are basically funded by their current liabilities. That is the reason, that is what has funded the total assets here, apart from the equity. So equity is one component. This amount has gone into funding this, the total assets. Apart from this, the balance has been funded by the current liabilities. Okay, so this is one. Then, of course, lastly, we look at the return per share of equity. Now, this is basically the earning per share. So for individual shareholders, the EPS is important along with the dividend per share. Why is this important? Because if you want to look at it from the point of view of an individual shareholder, then this becomes an important ratio to look at. You also might want to look at the dividend payout ratio. That is, you take the dividend and you find out the dividend as a percentage of the profit after tax. So if the company makes a profit of 100, what is the amount that it is giving as dividend? So remember, long ago when we were starting the course, we said that there are different dividend policies. One of them was called a constant dividend policy. So there are some companies which actually give a fixed percentage every year. Tanya is also coming. So there are some companies which give a fixed dividend every year, year after year. Good of you to come, Tanya. I thought you won't be here today. Good. So there are four.
Good evening, sir. Sorry, sir.
Good evening. Good evening. You're very busy with your projects. Have you forgotten whether it's evening or afternoon?
Sorry, sir. Sorry, sir. Actually, right now in my college, sir, NSS is going on, and sir, we have to make a project on it. मतलब, sir, थोड़ा ज़्यादा work हो जाता है आजकल. इसके वजह से I'm busy. Sir, 7-day का camp होता है, तो till Monday we are having that camp. After that, I am very free.
Okay, fine.
Yes, sir. Sorry, sir.
So you can look at the recording of this, where I explained that we will be having an assignment on this, on the entire course, which will happen on the 26th and 27th. So that is important. Just look at the recording when Neeraj sir shares that with you, so that you get an idea about what is happening. Okay. Now, next, what we are doing right now, Tanya, is what we did last time. So it's like a revision for you.
Yes, sir.
So return per share of equity, here again, basically all that has been done is that the profit after tax has been divided by the number of shares, and we get our earning per share. How much money has been made per share? Once again, we have these fantastic figures, but that is to be expected since the company has such a high return on equity. The next part here is the efficiency in the use of assets. Now, when we talk about efficiency in the use of assets, basically, we are trying to understand after the total amount, the total amount of assets that it has, what sales do they actually generate? What is the, the sales that they generate from the assets that they have? So, yes, Tanya? Okay.
Yes, sir.
So what are the sales that is generated from the assets? That is very important. So we look, and that is known as the total asset turnover ratio. So wherever the word turnover is there, you think of it as sales. So this, because see, the assets are being used to sell, to produce goods which are then sold. Ultimate objective of having the assets is to produce goods which can be sold. So in the ultimate analysis, your efficiency lies in your ability to produce more and then to sell more. The more you can do this, the more efficient you are considered, given a particular base of assets. So that is important. And here we will look at average total assets. How do we get average total assets? We take the assets for the last 2 years, divide by 2. That is our average total assets. Now, once again, I give you this, little table from the same company, Colgate-Palmolive. So essentially, all the tables that are here, I'll be taking it from either Colgate-Palmolive or from It's 40.8. Okay, so coming back here. So you can see here, the total assets are given, the profit after tax is given, the sales are given. Now, on the basis of this, it is possible for me to calculate the sales over average total assets, and I'm getting 2.6. Now, if you just do a division like this, profit after tax to total assets, you will not get 2.6. I think last week, Praveen ji had pointed this out, you get 2.4. But if you get the average of these two figures, it will give you 1,2 something, 1,2000 or something like that. And then you divide that average total assets by the sales figure, you will get this. So what you can see is that the sales is 2.6 times the assets that the company has. So that is the level of efficiency that it has. And the more sales it makes, the more profit it makes. So this goes up. So the thing to remember here is that the return on total assets is directly related to the total asset turnover ratio. This point you should try to remember. And similarly, the return on total assets is also derived from the margins which are there. The net profit margin. So both of these will actually influence this. That is why if you take 15.7 and you multiply it by 2.6, you will end up with 40.8. this is the main learning in this slide is this, that the total return is dependent on these two factors: the amount of margin from the sales that you make and the actual amount of sales that you are able to generate. Shruti, you're clear about this? Because we had done this in some detail last time.
Yes, sir. Actually, I've done all this in my accounts class, so I have quite a few idea on this.
Okay, good. So you contribute anything you want to say. Huh? That will make it easier. Then it's like a revision for you.
Sure, sir.
Then the example of efficiency ratios, return on total assets. We don't need to touch this. This is done. Then I've also given you here an example of a return on operating assets, where we take the operating assets, we take the operating profit, we take the sales, and then we try to work these things out based on the operating assets and the sales. So if you look at this, you can see that the operating asset turnover ratio is much higher, 4.3, and the return on operating assets is as high as 82.8. So how do these figures actually come? For that, what I had done was I had prepared one more slide. Why is that not coming? If you look at this slide, you will be able to see this here clearly. So if you look at the operating assets, what do we have here? It is basically the operating profit margin multiplied by the operating asset turnover ratio. So if you look at this table here, so you have the current assets minus cash and bank, and you have the fixed assets. So you're not taking other, and you get this. Operating assets is equal to current assets plus fixed assets minus cash, and you will get this 7468. And then you take the operating profit. And how do I get the operating profit? I take the profit before depreciation, interest, and tax. I reduce other income from it, and I reduce depreciation from it. Because during the course of operations, the assets are being used. And how am I sort of accounting for the use of the assets? I am doing that through depreciation. So I also consider the depreciation part. Now, once I do this, I get my figure here of operating profit. The operating assets are here. Basically, as you can see, the main thing to remember here is that cash is not taken into account, and I end up with this. Now, if I try to calculate this using the we learned in the last calculation, you just take the operating profit margin and I take the operating asset turnover ratio and I multiply this, then I also get the return on operating assets. So whatever we have done for the return on total assets, essentially we are doing the same thing for return on operating assets. The only distinction here is that for getting the operating assets, we adopt a method where we take out the cash and we also take out other assets. And for getting the operating profit, we take the profit before depreciation, interest, and tax, reduce the other income since it's already there, and we also reduce the depreciation because we don't want the depreciation figure to increase the profit. So that was one. This was the example from Colgate-Palmolive India Limited. And then we come to the solvency ratios. So in the solvency ratios, the main thing to remember is that solvency is about two aspects. One is the short-term solvency, the other is about the long-term solvency. So when we look at the solvency position of a company, we are looking essentially at these two things, short-term and long-term, and we're also looking at the operating cycle. Why we are looking at the operating cycle also becomes clear when you begin to look at the actual calculations. And then you begin to see that the operating cycle, particularly the length of the operating cycle, influences the short-term solvency in a big way. So as we go through the next slides, I think that will become clearer. Remember, liquidity is of a major concern for short-term creditors and the management. Anybody who has given goods to the company on credit, they are interested in understanding what is the short-term solvency of this company. Now, so what do we consider here? We consider debts falling due within the next 12 months. And so how does the company actually take care of this debt? Basically, it has two sources. It has the cash that is available with it in its bank account. Then if it can make any cash sales of the goods that it has, that generates cash. And apart from that, it also can collect receivables. Whatever credit sales they have made, they can get the money from their debtors. And that amount, these three things are what is available with the company immediately for payment of liabilities which have become due. So in this, we should look at the relationship between current assets and current liabilities. One thing to remember here is that if I take the total current assets, I reduce the current liabilities, what I'm left with is the working capital or the net working capital. Now, this working capital, since the current assets is more than the current liabilities, where is this money coming from? So basically, this is the contribution of the long-term sources of funds that the company has. So some part of its long-term funds are funds which the company has either because of equity that the promoters have contributed or the loans that the company has taken. These funds, part of these funds are used for financing the current assets so that the company always has a comfortable cushion of liquidity available with it for paying any liabilities which become due. So if you look at this example, it will become clearer. So one thing to remember is what is the main component of the liabilities? It is the payables. That is, that amount of supplies, raw materials or stock that you have purchased on credit. Now, if you don't pay this back on time, your reputation in the market suffers. And the result of that will be that in the future, you may not be able to buy raw material or stock on credit. And that will be a big, big problem for you. So that the other part of current liabilities relates to the operating expenses. You know, the salaries, wages that have to be paid, rent, electricity, telecom bills, advance tax, etc. That part also, all of those things have to be paid at the end of the month. So you will have to have the money. If you don't have money to pay salaries, obviously your employees are not going to tolerate this. They will either, it will reflect in their performance, and if you still continue not to pay, the chances are that they will leave the company. So we again stress that to make sure that the liquidity position is always comfortable, they have to have, the company has to have a certain amount of money, which is from long-term sources. Now, if we look at this table, we can see very clearly in the case of Marico, how what is the contribution here from long-term sources. So you begin with this, 15,892 is the current assets. And out of this, the current liabilities, 12,407. So the current liabilities have financed the current assets to the extent of 12,407. If you look at this little calculation here, you can see that the amount which is not financed by the current liabilities is 3485. Now this amount has come in from the current assets, from the long-term sources. How does that work? So we can see it here. If you just take that gap, 3485, add to it the net fixed assets, you add the other assets, you get this 24665. If you go back to the previous table, you see that we are basically taking the difference between these two. We're taking the difference between these two, the current liabilities and current assets, and that is 3485. Add the net fixed assets, add the other assets, you get this 24665. Where is this money coming from? So you can see that long-term loans are financing for equity is financing this amount, 19,815, and you can see this 24665 coming here. So essentially, this amount is these two together, apart from what, so these two together were used to finance the next net fixed assets and other assets. The balance was basically used for financing the net working capital. Is this clear, Shruti? This part?
Yes, sir.
Okay. So this is one part of what we did. And we now come to the current ratio. So as you can see in the current ratio, you have, it's very simple, assets to the current liabilities. Now, Shruti, since you've done this before, and Alice, I think you're also very well aware that normally we try to think of a current ratio of more than 1 and consider that to be good. But one way of looking at this is that there is no golden number, that it should be 1 or it should be 2. Basically, what happens is that it varies from industry to industry. That is one of the lessons that we should try to understand. Now, the current ratio is a measure of short-term liquidity. So basically, what are the funds that are available to you to meet claims by the current liabilities? So as you can see in the case of Colgate-Palmolive, they are at about 1. That means that almost all the current assets that they have been financed by their current liabilities. They don't, they are keeping a very, very thin cushion, 116 only. This is only 11 million. 11 crores, that's all. For such a huge company, they are only this much. So what do you think about this, Shruti? Why do you think it is so, so small? Normally, it is considered very risky.
Yes, sir. Maybe it has current. Maybe it has creditors or debtors, which are, maybe it has debtors who are very timely, who pay on time. That is why it can take such a risk.
Okay, that is one. The other thing is that because of the terrific brand power that this company has, it is, nobody will demand money from it. Nobody will actually demand money from it if it is not in a position to pay. Everybody knows that it is too big a buyer to ignore. So I think that is one reason. It's a reflection of the sort of market power that this company has. So normally you would find that this amount is going to be much more than this. If you were to look at the same ratio for Marico, that ratio is much more than this figure. Okay. If we look at the quick ratio, we basically take out the inventory from the current assets. Why do we take out the inventory, Shruti? So essentially, we take out the inventory because we are looking for only those current assets which can be converted into cash within a very short period of time. So essentially, inventory may take a little long to convert into cash. See, they have to be converted into finished goods, or the finished goods part of the inventory has to be sold. So it is a slightly time-consuming process. So we don't consider this when we are looking at the quick ratio. If you look at this from the quick ratio here is 0.8. So you can see that it's negative. They are actually, but normally you don't expect this to be very high. So no company can afford to, have that clear liquidity where even this is going to be 1. It's quite okay to have a liquidity of 0.8 because this can be converted into cash immediately. And quite obviously, all your current liabilities will not, become due immediately. People will come gradually to you. So that is one. And then we look at another aspect, of solvency. So if I know what my daily expenses are, with the cash that I have, how many days of daily expenses can I actually finance from the cash that I have? And that is why we call it cash cover. Or we can carry this. How many days of daily expenses actually cover with our current assets? So from the current assets itself, I should be able to cover a number of days of daily expenses. Now, how do I get my daily expenses? Basically, what I do is I take all my expenses, I do depreciation, and I divide by 365, taking 365 as the year. So cost of goods sold, all expenses related to the sales, to marketing, to the day-to-day running of the business. I also add tax and reduce depreciation because that is not an outflow. I divide that by 365, I get average daily expenses. Now, if I take the current assets and I divide by average daily expenses, I know how many days of daily expenses my current assets can cover. Similarly, how many days of daily expenses my cash can cover. So all that I have to do is first calculate the average daily expenses, then I divide current assets by that. It will give me a number of days calculation. So I know that on the basis of my current assets alone, I can handle all the expenses that even better, from the cash that I have today, from that alone, I can manage all the daily expenses for a certain number of days. Now, here is an example. So if I look at Colgate-Palmolive again, we have done exactly what we've written there. We've taken the cash, we've taken the current assets. We found out the total, the cost of goods sold plus the tax and all that. And then we have divided by 365. So we find that the average daily expenses is for the year of 2013 is 72. And the cash cover available on the basis of this 72, cash cover, that is 4288 divided by 72 is 60 days. And the current asset cover that is available to me divided by 72, I am going to get 110. So from the current, it is possible to finance my daily expenses for 110 days. And if I look at cash alone, my cash alone, the amount of cash I have to 188 crores, I can handle my daily operating expenses for 60 days. So this helps. So if I have this amount of cash and this amount of current assets, I know that I am solvent on a short-term basis. any demands that are there for running the business, I already have money for the next 2 months in case of cash, or in case of current assets. Is this clear to everyone? Shruti?
Yes, sir.
Alice?
Yes, sir.
And Tanya?
Yes, sir.
Okay. Then we look at operating cycle efficiency. Just so that we understand this very clearly, I've just put this little drawing here. So operating cycle is from the time we start with the purchase of raw material, cash goes to the purchase of raw material, that is converted into finished goods, that is sold, generating either cash or receivables, but mostly receivables. And then the receivables are collected and we get cash. Now, basically, if we look at this, we are looking at two things. How many days does it take to convert my raw material into finished goods? So that is the inventory conversion period. So if I get that, I can calculate it exactly into a number of days. And similarly, how many that is sold, assume that it is sold immediately. At least there will be arrangements with the dealers who will pick up the goods as soon as they are produced. So that part is not a time consuming part. The next time consuming part is after I sell the goods on credit, how long does it take to actually convert the receivables into cash? So if I know the amount of time it takes to convert this into cash and the amount of time it takes to take the raw material to finished goods, and if I add the two times together, I will know the number of days in my operating cycle. So that is the main purpose of this. And if the number is very high, I know that I need liquidity from that period, for that period totally. So from the time I have cash, I have bought the raw material, I am out of cash now. When will I get the cash back? Only after this cycle is completed. So if this period is longer, I am essentially out of cash for a longer period. So that puts stress on my liquidity. So the shorter the operating cycle, the less liquidity problems I have. So that is one point to always remember. Now, how do we get these turnover ratios? So the first thing we've taken is, I've gone in reverse order. So we take the accounts receivable turnover first. How long does it take to get cash from the debtors? So here what we do is we take the sales figure and we divide by average accounts receivable. Now, to be fair, we should be looking only at credit sales, because if you have made sales in cash, then that amount actually doesn't influence the because receivable. But that figure is generally not available outside the company. And since we do most of these analysis based on whatever data is available in the public domain, we look at the total sales. We take the total sales figure, we find out the average accounts receivable, just take the receivable figures for 2 years, get the average of that. And then when we divide the sales by that account receivable figure, we get the number of times, the account receivables rotate during the year. So the first step, sales divided by average accounts receivable. Now, once you get this average accounts receivable turnover, if you divide 365 by this, you will get your average collection period. So that is the amount of time it actually takes you to collect. And alternatively, you can also do it like this. So you get your average accounts receivable, find out your sales per day, divide the average accounts receivable by sales per day, you will get the same figure all over again. This average collection period. This basically tells you long it takes you to collect cash from your debtors who have bought goods from you on credit. Okay, so this is one. Here is an example. So if you take the sales of, let's say, Colgate Palmolive, you find that it is 31,638 million. You take the average accounts receivable, which is 842. It'll be actually the average of these two, 842 and 813. Now, if we divide 31,638 by 842, we get this. The turnover is 37.6. So what you see here is that it is happening very fast. So 37 times it is rotating. And what does this tell us? This tells us that the average collection period is 10 days only. How am I getting that? I am taking 365 and dividing by 37.6. The actual calculation comes to 9.7 days, but that has been rounded off to 10. So basically, anybody buying on credit from Colgate Palmolive is getting a credit period of just 10 days. Now, even that 10 days is good enough for them because the products are so well known, the market is so clear that in those 10 days, probably they will be able to sell most of the product that they have bought from Colgate Palmolive. So is this concept clear, this collection period thing? Tanya, Alice, Shruti?
Yes, sir.
Yes, sir.
So this is important, remember, because this, when I want to calculate my operating cycle, number of days in the operating cycle, this is one part. The other part is the inventory term. So this represents the resources the firm has invested for the purpose of facilitating operations. If you have too much inventory, that again is a problem for you. The amount of inventory that you actually have is, see, it's not possible for companies to basically have low. It depends on a number of things. Take the simplest thing, availability. So if you are into food processing and you're making mango pulp, mangoes will be available to you only during the season, the mango season. You won't get it always. So once they are available, you will have to stock. So at that point, your inventory will be very high. Another thing is, if the raw material that you use a very long distance, to cut the transport costs, you may want to place large orders in one go. Or if sometimes the certainty of the material being available on a regular basis is not there, then again you will have to buy in bulk. And when you buy in bulk, initially in your current assets, the inventory levels are going to be very high. And later on, of course, at some point, the inventory levels will come down. So it will not be, like that lean, where we talk about, a very lean way of doing the business, where we put in just enough amount of money in the inventory. That is possible. That will not be possible in some of the industries. But anyway, that is the inventory part of it. Inventory is related to the cost of goods sold, not sales. So any turnover that we are interested in here, we are actually looking at the cost of goods sold part, because right now the inventory will be used to produce the goods, and that the amount of the cost of production is reflected in the cost of goods sold part. How do we get this? It's the same thing again. We find out our average inventory, take the cost of goods sold, divide, and we get our inventory turnover. And then when we divide 365 by the inventory turnover, we end up with the inventory conversion period. So if you look at Colgate Palmolive, you can see that the inventory conversion period here is 6.2 days only. In 6, they're able to take the raw material that they have and convert it into finished goods. So we have our, we get our inventory turnover. Yes, that's correct. And then What is my conversion period? I take my average inventory. Sorry, I take my 365, divide by the inventory turnover, and I get my conversion period of 59 days. So 365 divided by 6.2 is equal to 59. So basically, when I want to calculate my operating cycle, I needed to know how much is my inventory conversion period, which I now know is 59. I also wanted to know how much is my average collection period, which I had calculated earlier. So once I have these two, I know exactly how long my operating cycle is. But I also have to consider one more thing, and that is my average payables period, because this is the amount of cash or credit that is available to me from my suppliers. So there is no cash outflow here. So if I have a very long average payables period, basically it means I am never out of cash. And we see that in the case of Colgate-Palmolive. So if a company has a good reputation, as Colgate does, they will be able to get credit from their suppliers for long periods of time. And because of that, their need for cash comes down. So first of all, we calculate it in the same way. We get the average accounts payable, basically find out, take the accounts payable for 2 years, get the average, divide by cost of goods sold per day. So get the cost of goods sold, divide by 365, you'll get your cost of goods sold per day. Once you do this, you will get your average payables period. And now, if you take 365 and you divide by this turnover, you're going to get you can calculate the average payables period in this way also. So you get your average payables turnover. This is the way we had done it with the collection accounts payable turnover also, accounts receivable turnover also, where we took the cost of goods sold and divided by accounts receivable. Here we're doing payable. Divide the accounts payable turnover, divide 365 by the account payable turnover, and you will get your account average payables period. Here you can see it in action. Cost of goods sold is 12,501. Average accounts payable, take these two things, get these two figures, get the average, divide, you get the payable of 3 times. Basically 4 into 3 is 12, you can see it here. And now if I take 365 and I divide that by 3, I will get the average payable periods of 122. Now the interesting thing here is that 122 is more than the amount of time taken for converting the inventory and collecting my receipt. So the figure that I end up with at the end is going to be a negative. So look at this. The average collection period was 10. The inventory conversion period was 59. I got an operating cycle of 69 days. But since the purpose of calculating this was to find out my solvency position, I also consider the amount of credit that is available to me from my suppliers, which is 122 days. So basically, I'm ending up with a minus figure of 53. Of minus 53. That means that in practice, this will be out of cash for its short-term needs. And you also find out that the operating cycles per year are 5.3. That, of course, is very simple. Once you have your operating cycle, you divide 365 by this, you will get the number of times, the number of rotations that the money makes. It starts, raw materials are bought, those are converted into finished goods. The finished goods are sold and converted to receivables. The receivables are collected and converted to cash. This process takes 69 days. So during the course of a year, this is happening 5.3 times. So I recall that when we were in the bank and we were asked to consider the operating cycle of small companies or small business enterprises, the rule was take four cycles during the year. So any small firm coming to us asking for a loan, we would consider the operating cycle to be 4, and we would finance in that way. So you finance for one cycle, and that cash which you give the company and the amount which they actually put in is recovered, then it is rotated 4 times. In this particular case, it is rotated 5 times. And you can see that the cash conversion period, the amount of time it actually takes to convert to cash, is a minus figure because of this. So they are getting the cash, but they don't have to pay because they have opted for delaying the payments to their suppliers. Are you getting this, Shruti?
Yes, sir.
See, this minus figure might be slightly troublesome. But remember, why we are saying minus is the whole purpose of calculating this, of course, one was to find out the number of days in the operating cycle and find out how many rotations there can be in a year. The other part was your actual need for cash. And here we can see that there is no need for cash because the average payables period is so long. That was the logic here. Then we come, of course, to the long-term solvency measures. So this is, I think, much more familiar to everyone. This is basically the relationship between debt and equity on the one hand, and the earning capacity of the firm on the other. That means whatever earnings it has, to what extent are the earnings sufficient to pay the interest on the long-term loans? So ideally, one hopes that the earnings are many, many times the amount of interest that has to be paid. So if you have an interest, you want to pay 10, if you're required to pay 10 rupees of interest every year, you should not have an earning of just 10. Then you will never make a profit. The idea is that your earning will be many times 10. So let's say if you have an earning of 50 and you are paying interest of 10, then the lender also knows, the person who gave you the money, the banker, he knows that you have sufficient earning to repay the interest. So that is one important part. Now, just a minute, please. Okay. So the first thing to consider here, of course, is the total debt to equity ratio. So we take the current liabilities, we add the long-term liabilities, we divide that by the net worth. The net worth, of course, will be the equity plus the reserves. Just one thing, Shruti, is my voice audible properly?
Sometimes there is a network issue.
But broadly speaking, it's okay, na?
Yes, sir.
Okay, fine. Because there was an issue here, and that's why I'm getting a little worried. Okay, fine. Then, so to what extent does the equity cover the total liabilities? So these are the total liabilities. And from these total liabilities, so remember, the liabilities are the outsider funds. Funds which have been given by people other than the shareholders. So the current liabilities are mostly funds given by the suppliers. The long-term liabilities are, of course, given by the lenders. To what extent does the net worth take care of this? So this is one important ratio. In this particular case of Colgate-Palmolive, of course, which has a very low amount of debt in any case, 1.7. So the total debt to shareholders' equity is 1.7. So 8,172 is the total debt. Out of that, the equity is 4,896. So if you divide, you will get 1.7. And the balance between these two This, in the case of Colgate-Palmolive, is being funded mostly by the current, by the creditors. They are the people who are actually funding it. So that is one thing to look at, is the long-term debt to shareholders' equity. Now, why this is important is that if I take out the current, the creditors, the current liability, if I eliminate that, what I'm left with are the long-term debt. And the long-term debt generally is the one which requires a payment at periodic intervals. Normally, for most companies, it is a big amount. So that ratio is taken. But in the case of, if you take the case of Colgate-Palmolive, it is only, it's a very, very small ratio of 0.1% of the total. So the total debt is 8172. Out of the total long-term debt is 357. The balance of 7815 is coming from current liabilities. Like I told you in the last slide also, that the main funding for Colgate-Palmolive is coming from their current liabilities. So I get this particular ratio. This is the one you remember: long-term debt to shareholders equity ratio. Debt equity ratio is also, that's another way of looking at it. And from this, I also calculate the times interest earned ratio. So the interest expense that I have, how many times of this are the earnings I am getting? Basically, the profit before interest and tax. These are the actual earnings of the company. How much am I getting? How much more is that as compared to the interest expense? So you can see that here. This again is a ridiculously low figure for Colgate-Palmolive, only 13. This is 13 million. So it's 1.3 crores only interest expense. The earnings before interest and tax are 6,643 million, which means that the amount of earnings that they have, it is 511 times of the interest payments that they have. So for all practical purposes, we should just not consider this important for this company. But what is important for us is to just note the way it is being calculated. Okay. It's important normally when this level of, this amount of cushion is not available with the company. And it's important because if interest is not paid to the bank, then of course the account is categorized as non-performing, and that creates a problem. That is the major thing to remember. This is why this ratio is important. If you're comfortable, as in the case of Colgate-Palmolive, no problem. You can just ignore this part. Then we come to something called the equity multiplier. Basically, what we want to see is when people invest in a company and create that equity, when they go and actually start the company, they take some debt. And people are willing to give them the debt because people believe in the business model that these shareholders have created. So the total assets that they create are much more than the actual amount they had invested themselves. So basically, we want to find out what is this multiple? How much more of total assets have they created compared to the equity that they had put in? Because remember, the return that they are getting is on the total assets. But the actual amount of money that they invested in the beginning is only confined to the equity portion. So if they can get more debt and earn a rate of return which is more than the interest, the cost of the debt, then what will happen is they will generate more wealth. They will generate more wealth for the equity shareholders. So this is why the equity multiplier is important. If they can take debt, generate a good income from that debt, continue to repay the debtors comfortably, then in the process, the amount of profit that they are getting is much larger as compared with the profit they would have got only with equity. So this is the leverage thing coming in here. So different words are used. And so the equity multiplier here, you're just taking the total assets, you're dividing that by the net worth, and you're getting the total. So basically it's 1 plus total debt to net worth. If
Sir,
you
how is net worth different from total assets?
see, the net worth is only the equity part, Shruti. This is what I've been trying to explain. So see, total assets is total debt plus net worth. Here. The total assets that the business has, see, look at this example here in Colgate. The equity that these guys put in, the net worth is only 4,896. But the total assets that they have is 13,067. Where did that money come from? They borrowed that money. So for the moment, forget whether it's long-term, short-term. They borrowed that money and they created the assets from the borrowed funds, apart from the amount that they had invested on their own. So if you say total assets, the total assets is also equal to the total debt. Total debt, what comes in total debt, Shruti?
All the liabilities.
All the liabilities. So you have the current liabilities and the non-current liabilities. You add that. And you also add the equity. So the net worth is the equity, that is the shareholders' funds that is coming here, equity plus reserves. You are adding this. These two together are financing the total assets. Now, if I take the total assets and divide by the equity plus reserves, which is the net worth, that is my equity multiplier. That is the extra amount that I have managed to create from the base that I had. For example, if you take Colgate-Palmolive, they had a shareholders' equity of 4,896. But the amount of total assets that they were able to create is many times that. It is 13,067. It is 2.7 times that. I've done the calculation this side. It is 2.7 times of that. So that advantage they are getting because the people who have given them credit, in their case, of course, it is the suppliers of raw material, but in many companies, it would be the long-term lenders. So when they believe in the business model that you are doing, what are they believing in? They are believing in the ability of your business model to generate profit. And when they believe in that, then they are willing to give money to you on credit. And that is the debt component. So you can use their money, you just have to pay them interest, and buy assets for yourself, use those assets to produce goods, sell those goods, make a profit. So see, that is the concept of the equity multiplier. So I am using not just my own funds, I am using borrowed funds also. And the total, the amount, the extra amount that I get, that is the multiplier. Are you understanding this, everyone? Shruti, is it clear?
Yes, sir.
You sound a little hesitant.
Yes, sir, a bit of, but I'll read it on internet, then I'll be super clear on this.
No, we should discuss it here. Look at this. Total assets are here. Where are you financing your total assets? Some part is coming from equity, net worth, and the rest is coming from where? From the amount you borrowed. See, every asset that you have has to have a matching liability. That part is very clear. It has to match. So where are you getting your total assets from? Who gave you the money to get the total assets? Some money you gave yourself through the equity. And the rest somebody actually gave you money. They trusted you with their money. You took their money and you bought assets with that. You also bought assets with your own equity. And together you created your total assets. Now, if you take your total assets and compare it with the equity that you have, you find some times your equity. In this example, 2 times more. So that is the equity multiplier. Alice, are you clear on this? Tanya?
Yes. Yes, sir.
Okay. So that's one thing done. Then we did this analysis where we used, we took these and we tried to understand it in terms of the DuPont analysis. Basically, what the DuPont analysis is doing is, it is taking three components. It's taking the net profit margin, it's taking the total asset turnover, and it is taking the equity multiplier. And what it is saying is that my return on equity is basically a function of these two things. The net profit margin and my total asset turnover and my equity multiplier. If I take these three ratios, I multiply these three, it will be equal to return on equity. So you can calculate return on equity in the simple way. You get the profit after tax divided by your net worth, you'll get your return on equity. But what DuPont is suggesting is that this return on equity is a function of three things. One is, how much actual net profit margin do you have? When you make sales, you get a certain amount of money. After taking care of all the expenses and everything, what is the amount left with you? What is this margin? For every 100 rupees of sales that you make, what is the amount that you get? That is the first component. That is the first component of your return on equity. The second part is, with the assets that you have, how much sales are you able to generate? The more that you generate, the more profit you will. And the third part is the equity multiplier. Because the total assets that you have, that depends on your equity multiplier. Let's say you don't have any debt. Then, of course, the amount which you will earn, the return on equity, will be less relatively than a company which has debt and which is able to generate a return which is higher than the cost of debt. That is the logic. So basically, you are using three things: margin, NPM, volume, sales, and leverage. Leverage is the amount of debt that you have taken. So in the examples that we have, if you take from the tables that are there, if you take these three basic ratios, margin, the return on total assets, asset turnover ratio, and the equity multiplier, you multiply these three, you will get the figure that you get will be your return on equity. So it's one way of understanding this is, the technical word they use is, it is a decomposition of the figures. So the figures are there, it is deconstructing the figures, it is reducing it to smaller components. And these components are margin, volume, and leverage. So a company which is able to get better margins, there will be some companies which will be able to get more margins. So you look at this. Banking focuses on leverage. So how much more can I borrow? For banking, that's the big thing. Because the deposits that a bank gets are all borrowings. So how much more can I borrow? The more it borrows, the more it can lend. And the more it lends, the more it can make. But the margins in the case of banks are not very, very, significant. Because it's a very thin margin, actually. So you make your money from leverage. In some cases, the reverse, luxury car maker. So luxury car maker has the privilege of charging a huge amount of money from their customers, because people want to possess that car for the status that it gives them. So let's say a car maker like BMW or Skoda or someone they can actually focus on the margins. But there are other companies also selling cars which may want to focus more on volume. For example, Maruti, you take typically the, let's say, the entry level Maruti and the next level. The sedan level, like Desire, Maruti Desire, which is so common, the Swift Desire. So there, what is Maruti doing? It is focusing on selling more and more of these cars in the market, keeping the price very, very competitive. So when they do that, so if you were to go and buy the same car, but from a brand which is very famous, like let's say you take it from Honda, and basically you buy the same vehicle as Desire, but you buy the model which Honda has, which is called Amaze, then you will find that Amaze sells at a higher price than the Desire. So Honda, by virtue of its brand, is looking for a higher margin. So out of these three, it will look at this. It will focus on margin. The margin actually people will, and from these two they will earn their price. Which part driver? See, the main driver for these industries is the margin or volume. For banking, the main desire thing would be leverage. Also, like traditional companies, which are there for ages, the Birlas and all, Tatas, Birlas, for them, using their reputation to get more loans, that is more their style. That is what they do. So if you understand DuPont, you understand that different companies use different strategies to make profit. That is why I find that DuPont really gives you a lot of clarity, brings a lot of clarity to the financial statements that you analyze. Are all of you getting this clearly?
Yes, sir.
Alice?
Yes.
For you, this is of course a repeat, Alice. So I'm sure that it's a good revision for you that way. We now come to the next part here, which is a comparison using the okay. From now on. See, we already have done the, just a minute. So we have basically understood of the profit. Now what we really want to do is, these two companies, let's say we take Colgate and Marico, the two companies that we have been using, and we try to compare. So who's the operating C companies are. So for example, if I ratio,
Sir, could you please repeat? You were not audible.
yes, Alice? I just with you and plug phone into as a backup. Shruti, am I audible?
Yes, sir.
Okay. Shruti, sorry, Alice, what were you asking me? Alice, can you hear me?
Sir, I was asking.
Yes, what were you asking?
Sir, I wasn't. Sir, I think it was Shruti.
Acha, acha.
Sir, I was
Shruti,
asking
were you
you to
asking?
repeat. Yes, sir. I was asking you to repeat this whole slide because the moment you shifted to this, you were not audible.
Okay, fine. So basically, what we are doing here is that we are comparing two companies, Colgate and Marico. 4 years data is there, and we are trying to look at all the short-term solvency measures. Now, why this is important is that suppose tomorrow you have to do a comparison. Let's say you are given the balance sheet figures, you are given the profit and loss account figures, and you have to do a comparison of any two companies. And I look at it from different aspects. So suppose I take short-term solvency. In the short term, does the company, what is the question I'm asking? In the short term, does the company have sufficient liquidity to take care of its liabilities? Because ultimately, if it doesn't have that liquidity and it is not able to take care of its liabilities, there is going to be a huge loss of reputation, which will have impact in the long run. So what are the different things that I should consider? I look at my net working capital. So current assets minus current liabilities. I also divide current assets and current liabilities and get my current ratio. I get my quick ratio by taking my current assets, reducing the inventories, and then dividing by current liabilities to get this. Then I get my average daily expenses. Basically, what am I doing? I'm taking my cost of goods sold, and I am taking that and dividing that by 365. I'm getting my average daily expenses. What is the amount of expenses that I need? Cost of goods sold plus operating expenses plus tax. That is the amount of expense that the company has. The annual figure is available in the balance sheet. When I divide by 365, I get the daily figure. So I get this. And then I take from the daily expenses figure, I then find out how much cash do I have. Based on the cash that I have, how many days of daily expenses can it handle? So I get that. Similarly, based on the quick assets that I have, that is the current assets minus the inventories, that amount, it is liquid, it is available for me for my day-to-day work. How many days of the daily expenses can I actually get from my quick assets? And then finally, how many days can I get from my cash itself? So I get all these, the cash cover, the quick assets cover, the current assets cover, and I also get the current liabilities cover for daily expenses. Basically, the current liabilities that I take, how many days of daily expenses does this also cover? I take all this. Now, once I get all these figures, I am in a position to look at the solvency position of this. So for example, if I take here, what we can see is that the Colgate's current ratio is near 1, quick ratio is less than 1. Now, normally, this ratio is not considered to be sufficient. 1 and 0.8 means that there is no cushion. So one of the things which you learn in accounting, which I have also just told you, is that to maintain a sufficient level of liquidity, what you should do is have a certain amount of current assets financed by your long-term sources. For example, in this in the earlier table, we saw how the long-term sources were contributing in the case of Marico. So since it was contributing, Marico has this cushion. Device is giving you 1.3, 1.4, 2.4, 2.2. They have also reduced. But essentially, it is very clear that they are paying attention to the liquidity aspect. Now, Colgate is not doing that. So one thing which you can see very clearly here is that Colgate is not worried about liquidity. Why? Because it has tremendous market power. It has tremendous market power because it is a huge seller of FMCG goods in its own space. In the personal care space, it is a huge seller there. And it, as a buyer of the particular raw materials that it needs, the chemicals that it needs, organic and inorganic chemicals, it is again a huge buyer. So because of that, so the huge buyer part, you call that monopsony. The fact that it's a huge seller is monopoly. What does this mean? It means basically that it is able to use this market power to dictate its own terms. And that is why they are not worried about anybody making a sudden demand for cash. And that's why they say that we don't have to have a cushion. So see, if you have a cushion, then that cushion has to come from a long-term source, and that means there is a cost. Where will you get the money? You may have to borrow the money. If you borrow the money, there'll be a cost. If you don't borrow the money, if you take it from equity, then again, if you're locking it up in current assets, maybe there was a better use for it. Or maybe you just had to have a higher level of equity to do that. Maybe you can achieve the same thing by having a lower level of equity and getting that from the market. So that is one. Then you can also see that why are they so okay with this one? Because the cash cover is very large. You can see that based on the cash that this company has, they can actually finance their daily expenses for 60 days, just from the cash that they have. From the quick assets that they have, that means the current assets less the inventories, they can finance for 84 days. And from the total current assets that they have, they can finance for 110 days. The other side is, if you look at the current liabilities and its relationship to daily expenses, then current liabilities actually give them 109 days of relief. So we understand exactly where this company is. Now, if you look at Marico, you'll see that it is nowhere near Colgate as far as this is concerned. So the cash cover that Marico has is 24. So they can run the company with the existing cash that they have in the bank for 24 days as compared with 60 days in the case of Colgate. The quick asset cover that they have, Marico has, is 66. So the current assets of Marico reduce the inventories, whatever figure you get, those are very liquid. That amount can actually finance the daily expenses for 66 days. The total current assets that Marico has, that means including the inventories, that can finance the daily expenses for 145 days. Liabilities that they have, that is basically, it finances daily expenses for 113 days. Take this whole thing, you begin to understand, you can ask the question, you can answer the question rather, does this company have a comfortable level of liquidity or not? That is the basic thing out here. Is this clear? Shruti, Alice?
Yes.
Tanya?
Yes, sir.
Okay. Now, I have also, like elaborated this, the same thing with these notes here. So the words I have used are, Marico has an aggressive policy. It requires a lower level of working capital, but it is a little risky. Colgate maintains a very high level of cash. This high level of cash that Colgate maintains, because it has a cover for 60 days, this is their way of compensating for the current ratio being low. So this is one. This is basically a conservative policy. Marico, by comparison, having cash only for 24 days, that is considered to be an aggressive policy. So that's one. Now you look at operating cycle efficiency. So if I want to find out how efficient, comment on the operating cycle efficiency, then I look at these particular things. Basically, I'm looking at all the different ratios or periods that I used to calculate the operating cycle. For example, the average collection period, inventory conversion period, the average payables period. I remember from the earlier tables that the average collection period was total is 69. Here's your operating cycle of 69. And when I divided 365 by 69, I got 5.3 operating cycles per year. So that from cash to cash, it happens 5.3 times during the year. That's one. We also found out from the average payables period that the company has a very high payable thing, a period of 122 days, which basically means that it is never out of cash. There is never any pressure on it or cash, because it has deliberately put in place a policy of delaying payments to its suppliers. So this again is something which we can discuss, for other aspects. So when you delay payments to your suppliers and you buy goods on credit, and the supplier knows that he is not going to receive money for the next 4 months, 122 days is roughly 4 months, then the supplier will not give you the best price. He will try to charge a little more. So it's never a free trade. If you force your suppliers to give you a very long period of credit, the flip side of that is that the supplier will also charge you more. So that is one interesting thing here, about the payable period. But Colgate has deliberately opted for this. So instead of taking long-term debt and all that, what they have done is they simply used this to this particular method of financing its current assets. So the inventories that they have, which are reflected in the current assets, they are basically they are being bought on credit. And by the time the credit actually becomes due for payment, they have processed the inventory, converted them into finished goods, sold the goods, and then even collected the goods. All that took them 69 days. And 69 days has gone, they still don't have to pay. So they have completed almost 2 cycles by the time the first bill comes up for payment. So you can look at it like this also. So that way they are very comfortable as far as their liquidity is concerned. Now look at Marico. Marico has you can see here the inventory conversion period is 112. Average payables, the average collection period is 16. You add these two, you get an operating cycle of 128 days. So it's longer. It's a longer period here. So you get 2.9 times. 2.9 times. For them, the average payable period is only 59. So by the time they complete one operating cycle, they have to pay their suppliers twice. So what does that mean? That means that they will have to have that liquidity available to pay the supplier. because they bought the raw material, they are in the process of converting it into finished goods. The finished goods are still being converted. Meanwhile, the suppliers are asking them for payment 59 days later. So they now have to pay the supplier. They need cash for that. Then they buy a fresh lot from the supplier. 2 months later, again that is due for payment. But they still haven't got their first round of cash back from the amount what they had produced, because this is more than 2 months. So again, they'll have to arrange cash to pay the supplier. So basically what is happening is the amount of liquidity which the company requires is higher than Colgate. Because in the case of Colgate, by the time the payable became due for collection, for payment, they had already had almost 2 operating cycles and they had cash ready. They had earned the cash to pay the payable. In the case of Marico, that is not happening. So that is the interesting thing which you see from these figures. And you also see that the average payable period is 59, which basically means that the cash conversion period is 69 days. So this is the learning from this. The way this company is being run, it gives you an idea about the amount of cash that it needs to run the company and how comfortable is it. So how has Marico handled this? It has done this by not relying on the current liabilities to finance the assets, but to take money from the long-term sources and use that as a cushion. So whenever the payable becomes due, even though they have not completed their operating cycle, money is available to them from their own long-term sources to take care of the creditors. So that is why we saw, when we looked at those tables with net working capital, that is why Marico has made sure that they have sufficient long-term funds available to finance the current assets also. That is the logic of this. Are all of you seeing this properly?
Yes, sir.
Yes, sir.
Okay. Then there are many more, questions which come, which I have written here, which you can read on your own time when I send this slide to you. So it will give you an idea about some things which are not there in the figures. The type of raw material Colgate buys, the type of raw material Marico buys, you'll begin to get an idea about that. So read this. What this also tells you is that it is not sufficient to only look at the figures if you're analyzing a company. If you have if you're giving an exam, like for example, Shruti or Tanya or Alice, you will have to give exams. In that particular case, you will of course have to rely on whatever conclusions you can draw from the balance sheets and profit loss accounts given to you in the exam. But if you are, sitting and trying to analyze the company and you have the benefit of the internet, then it is necessary for you. In fact, it is highly recommended that you look at the detailed picture of the company. Look at the qualitative aspects. For example, here, a look was made at the type of raw material which Colgate buys, the type of raw material which Marico buys, and what impact this has on the prices and the working capital management policy that it has. So it is always advisable to search for more information about companies which are generally qualitative in nature. This information that you get is qualitative in nature. The quantitative part is already there on the table. What you are now looking for is the qualitative part, which you will find when you research the company on the internet. There is generally enough information available about that. So you'll get a lot of things there. I will recommend that you read this properly, read all this. It will give you a good idea. There's no point in me reading this out to you. it's very, very clear. It is based on the tables that preceded it. You won't have a problem. Okay, now the next thing that we're looking at are the long-term solvency ratios. So here, what are the things that we look at? Total debt to equity. Total debt to equity. This is the, as a banker, ex-banker, I would say that this is one of the main ratios that we always look at. Then long-term debt to equity. So long-term debt is generally the debt which you get from lenders at a certain fixed rate of interest. So that's or where you raise money from bond holders. You float a bond issue, you get money. That again is a long-term debt. Once again, it's always the interest rate is generally fixed. Then the long-term debt to fixed assets ratio, basically trying to understand to what extent are the fixed assets financed from your long-term debt. Then the times interest earned ratio, which we already, how many times the interest cost is the earnings. So if I take the earnings and I divide by interest cost, how many times will that be? Then the fixed charges and interest, the only difference would be there are some companies which make lease payments. They lease assets and they pay for the assets. The lease, the amount of lease rental, they keep paying that. So that is the fixed cost. They will have to pay that every month or every quarter or every year, just like they pay the interest. So the interest is one fixed charge, the leased is another fixed charge. So in the case of this Colgate here, you can see that the interest earned times interest earned ratio is 511. Because if you remember, the amount of interest that they are required to pay was only 13. But if you look at this, the interest to fixed charges, you look at the relationship between the profit that they have and the fixed charges, there it comes to 8 times, which means that some of the expenses that they have in the nature of fixed expenses are different from interest. So that is one. Then, there are these three ratios, which basically are particularly this one, the net gain from borrowed funds and the gearing percentage. These two are looking at the amount of profit that a company makes because it borrowed money. So if it had not borrowed the money, it would not actually have made this profit. So what is net gain from a borrowed funds? You calculate the profit earned on the average borrowed funds. What is the amount you earned from the amount that you borrowed? And from that, you reduce the amount of interest that you pay on the borrowings. So in the case of Colgate, that figure is coming to 415 crores. So since we now know that in the case of Colgate, the main source of borrowings are creditors for raw materials, you can see the amount of money they're earning from it. 415 crores is coming. This is also the case because they are not paying interest. So we say profit earned on average borrowed funds, less interest cost. But since in their case, the interest cost is only 13, but the amount that they actually borrowed is much, much larger than that. So they have that advantage, huge amount they're earning. If you look at Marico, even they, you can see, are doing a very good job with the borrowed funds and earning net gain is 213 crores. So the amount they earned, the profit they earned from the borrowed funds, which were invested in their assets and they generated profit. So that's how they got the profit. From that, you reduce the interest that they paid on the borrowed funds, you're getting this figure. Equity multiplier, we've already done. And gearing percentages, the percentage increase in the earnings to shareholders by having fixed interest borrowings in the capital structure. So it's the same thing expressed as a percentage. Essentially, what these three things here are telling you is that how well is the company using its borrowed funds and how comfortable is it in paying back these borrowed funds. So if a company is making a net gain from borrowed funds, then obviously any lender is happy to give it credit because it knows that this company is making a gain. So it has no problem in paying my interest and the principal money that I gave, which I advanced to the company. So that is the big advantage there. So go through this, you will find that it's quite interesting. You know, I've tried to simplify this for you by writing the major point here, like total debt. Total debt includes current liabilities like cables. This is significant for Colgate. Or here, times interest ratio, total earnings divided by amount of interest paid, times fixed charges, total earnings by fixed charges, net gain, profit from borrowed funds less cost of funds, and gearing, percentage of extra profit earned due to borrowed funds. So you can see that in the case of Colgate, the extra profit they are earning from borrowed funds is 54.9%, and all are short-term borrowings. That means all from creditors. In the case of Marico, the percentage of borrowing is coming to 13.4%. So it's very sort of interesting when you take figures and you arrange them into ratios and then try to understand them. So I will send this to you today. Have a look at this, and you can also look at the comparison of the two companies using the margin ratios: gross profit margin, operating profit margin, and net profit margin. So you can see that both companies are doing pretty well. There's no problem really here. Gross profit for both is fantastic, 60 and 43. Operating profit, 19 for Colgate, 12 for Marico. Net profit margins very healthy at 15.7, 8.6 for Marico. So both these companies are obviously good players in the market, and this analysis says that the pressure for Marico has been due to recent downward fluctuations in its gross margin. So the gross margin used to be 47. It had actually come down to 38, and it is still lower than 47. But if you look at it, this conclusion is not entirely correct. Because if you look at the net profit margin, that seems to be steady at 8.6, 8.7. So this is the amount of net profit margin that they have. Not very, I would say that it's not exactly fantastic, but it's there. If they can generate more sales, they'll end up with a better return. The normal return on equity for Indian companies is 11 to 12%. If you consider that and then look at these return for investment ratios, you will be able to appreciate just how good these ratios are. So Colgate with more than 100, of course, is off the charts. But if you look at, let's say, Marico, even they are giving you a return on equity of 25, 30, 35, which is really very, very good return. So their profit margin may be low, but obviously the equity multiplier and the total asset turnover, that is good. Remember, when we looked at DuPont, we said we're looking at these three things. We're looking at margins, we're looking at volume, and we're looking at leverage. So in the case of Marico, the margin side is not so good, but the other two are good. The volumes are good, the leverage is good. As a result of that, the return on equity from the shareholder point of view, they're still doing excellent work. 25, 30, 35. So if you see a company with a low net profit margin, it doesn't really mean that it's bad or something. Ultimately, you'll have to see of the three things that are important: the margin, the sales figures, and the amount of debt that the company has taken. Out of those three, is the company at least doing one of the three well? Even if it's doing one well and the other two are average, it will still end up making a good profit after tax. And then it will be reflected in these particular ratios: return on operating assets, return on total assets, and return on equity. The return in all these cases, remember, is the profit after tax. After everything has been paid, what is left with the company? So this is I've even given you some reasons out here. Why are the returns so impressive? So both of them have created their own brands. Both have niche segments within the broad sector. Colgate is a bigger global brand with a niche in the toothpaste market. Marico has reputed local brands with a niche in the hair care and edible refined oil markets. So since they are significant, like shareholders, they have significant market share in these markets. That is the reason why the figures here that you're seeing are very good. Okay. So we are now at 8:05. Any questions?
No, sir.
So I'll send this to you, and I would suggest that all of you have a look at these figures. Alice, Tanya, of course, Shruti, I had sent it last week also. But last week, I think the last 10 slides are not. So what we'll try to do is find this up tomorrow and then start the banking part tomorrow itself, so that I can, because now I want to focus more on revising what we did before and making sure that you guys do your assignments. So that is what I'm most interested in right now. So we will think about what I told you, that I'll be giving you an assignment, you'll prepare it at home, make a presentation. We'll have an interview where I'll ask you questions from the different units in this course. Just put that in the back of your mind, think a little about it, think about how to prepare for it so that all of you do well in that. Okay. So I'll stop sharing now. And if nobody has questions, we'll end here today. Is that okay?
Yes.
Yes, sir.
Yes,
Okay.
sir.
Fine. Then good night, everyone. And Tanya, all the best for your project.
Good night, sir. Thank
Good
Thank you, sir.
Good night, Praveen ji.
Thank you, sir.